Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following #QC Weekly Comment on LinkedIn. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and this week I'm delighted to be joined once again by regular commentator and head of fixed interests Richard Carter and Oli Creasey, our lead property research analyst. Welcome, Richard and Oli. So in last week's podcast, Richard was talking with Christopher Scott about the Governor of the Bank of England's recent comments that the UK was now much nearer to the peak of interest rate cycle than before. And perhaps in doing so, Andrew Bailey was signalling that the Bank of England is now starting to focus on the risk to the economy if interest rates remain too high for too long. And since then, there have been a number of important reports and updates that were released over the course of last week. And this included the latest inflation figures from the US, which saw the consumer price index rise from 3.7% from 3.2%. And while this was primarily due to recent increases in the oil price, even core inflation, which excludes food and energy costs, saw a slight upturn of 0.3%. And in addition to the increases in fuel prices, in the UK, the Office for National Statistics reported last week that average UK wages grew at 7.8% and by 8.5% if bonuses are included, and the latter was boosted by one-off payments to NHS workers and civil servants. And this came about despite a slight easing of what has been a tight labour market, and means that the wage growth in the UK is now above the current 6.8% inflation figure. The update on UK inflation for August is due to be announced on Wednesday. And in terms of where those wage rises are coming from, the highest increases are being seen in the financial services and manufacturing sectors, and perhaps not unsurprisingly, the lowest increases are coming in the construction sector, where interest rate rises are starting to have an effect, and we'll be discussing this later with Oli. The European Central Bank also met last week and raised deposit rates by 25 basis points to 4%, which is the highest level European interest rates have ever been at. And that decision to raise rates was far from clear-cut and comes at a time as growth forecasts for the Eurozone have been scaled back. Richard, the financial markets have had time to digest those various reports and updates, and attention will now focus on the pending UK inflation data, which is due to be announced on Wednesday, and interest rate decisions from the US Federal Reserve Bank and the Bank of England's Monetary Policy Committee, who both meet this week. Was there anything from last week that surprised you or was particularly noteworthy that might influence those central bank decisions this week, or perhaps change expectations over the medium term that we are indeed nearing the peak of those interest rate cycles?
No, Andrew, I think you covered it very well in a sense in the introduction. I mean, I do think base case remains that central banks are, at or close to the peak in interest rates. And you're right, that's certainly what we've been hearing from some of them recently, despite, obviously the European Central Bank going ahead with another rate hike last week. I think what I would characterize some of the data recently, maybe there's a bit of a disconnect opening up between what we're seeing in the US and maybe what we're seeing in the UK. So US data is actually pretty resilient. There doesn't seem to be so far a massive impact from higher interest rates. The consumer's still spending money. Actually, some of the housing market data is not too bad either. So the Fed, although the Fed's probably not going to do anything this week in terms of rate hikes, rate cuts are certainly a long way off, which I think probably what they'll be indicating this week. And it may be that, if inflation remains sticky, that they may need to do another rate hike before year end. And I think the sort of, rise in the oil price that we've seen last week or so is becoming a little bit concerning, certainly for bond markets. So that's certainly been pushing up treasury yields recently. But then I would, say the UK, if you look at some of the data which you mentioned, housing, some of the growth data, there are more signs, I think, that the rising interest rates has had started to have quite a big impact on the economy. And the MPC Monetary Policy Committee will be concerned about the risk of over tightening. So probably another rate hike to come this week, again, because of just sort of sticky inflation, all the rest of it. But I think overall the balance of risks are becoming that they're going to do too much. So that hopefully, if they do raise rates this week, maybe we can just hope that might be the last one in the cycle. We'll have to wait and see.
Thank you, Richard. And with interest rates having risen so sharply with 14 consecutive rate rises so far this year and a 15th widely anticipated this week, we are now seeing an impact on the housing market. And according to the Bank of England's quarterly survey of lenders report for the second quarter, which was published last week, UK residential mortgage arrears have risen to the highest level for 7 years. The number of borrowers who have failed to meet their contractual payments or had their homes repossessed is still low compared to the 2008-2009 financial crisis, which will in part be due to far more stringent lending criteria that came in following the financial crisis. But with an estimated 1.6 million mortgage holders due to renew over the next 12 months, it seems unlikely that we have yet to feel the full impact of the interest rate rises filtered through. The Royal Institute of Chartered Surveyors, RICS, also issued a property market update last week. The report stated that housing demand and prices across the UK have once again fallen, and that the house price balance, the difference between the percentage of surveyors seeing rises and falls in house prices, fell to its lowest level since April 2009. As mortgage costs have continued to rise sharply and with average house prices widely anticipated to fall further, the outlook for the housing market is looking pretty gloomy. Oli, that sentiment certainly seems to be reflected in the share prices of the listed house builders, and we've seen profits warnings and dividend cuts so far this year. And the UK's largest house builder, Barratt, said last week that it does not expect the market for new homes to recover for at least 2 years. So what are your current thoughts on the outlook for the house building sector in both the short and the medium term? Are there any sort of glimmers of hope that investors can cling onto?
Yeah, thanks, Andrew. Very good question, because it is a pretty gloomy outlook, I think. Although it's not as gloomy as it perhaps could be. And I think just to sort of set the scene a little further, a lot of the house builders, you're right, have issued some profit warnings. We've seen share prices fall pretty sharply. So far, what has driven all of that has been falling volumes. So, clearly, you don't sell so many houses, you don't make so much profit as a house builder. But what I try to remind people is that when you don't sell a house, it's profit deferred, which is, I suppose, less bad than selling at a low price, which is, profit destroyed effectively. So, that just take that into context. That what we've seen so far is that fall in volume and the impact that's had. House prices have started to crack, depending on exactly who you ask and which index you subscribe to. But they haven't really cracked and they haven't really gone down yet. And again, you're right to say that probably a further fall is anticipated, but I will confess I've predicted a falling house price many times before and typically been proven wrong by a market that's got an awful lot of buoyancy to it. So yeah, it's a little bit of a sort of watch this space situation, because so long as volumes stay low for a couple of years, that's going to be tough for house builders, but it's a tough situation that they probably can recover from. Once values, and house sale prices are falling sharply, that's going to be a sort of a new paradigm for this sector. So I would say my thoughts are relatively balanced in terms of what could happen to the house builders market for the next, let's say, 12, 24 months, so long as prices sort of stay within a, let's say, minus 10% peak to trough sort of situation. If they break through that in a downward direction, then it'll be a different type of situation and a far worse one. Now, sorry, you did also ask for a glimmer of hope. The best I can offer, to be honest, and it is a real one, but it's very hard to quantify. But it is that historically, politicians have a bit of a habit of maybe interfering, maybe influencing this market. Maybe delete as applicable. We've seen help to buy schemes, we've seen stamp duty holidays, mortgage guarantees, and so on, all been announced over the past 10 years. And each one has, intentionally or not, supercharged the housing market. This is an election year that we're going into the next 12 months. The Conservative government traditionally favour homeowners. I wouldn't put it past anyone to try and maybe just I don't know whether you'd call it saving their own skin, or indeed just being altruistic and trying to help out a struggling population. But influence in this market is far from ruled out, and any sort of scheme that gets announced could just have similar effects as it's had in the past. So that would be a glimmer of hope, I suppose.
So, and Oli, just quickly turning to the commercial property sectors, we've now had a sort of reasonable period of time whereby post-COVID workplace patterns have become more established, and whether that's a return to the workspace full time or working from home or some degree of hybrid working. What trends are you seeing across the various commercial property sectors, and what are your thoughts looking forward? Do you expect higher interest rates to have a similar effect to what we're seeing appear in the residential housing markets?
Yeah, to be honest, Andrew, I think that the higher interest rate environment has already been accepted and adopted by the commercial market, which, to be completely honest, really paints the experiences of the residential market in quite stark contrast. Property values across commercial sectors in the UK have probably fallen about 20% since maybe just over a year ago now, and that is a reflection of higher interest rate expectations, which are soon to become a reality, I expect. To be honest with you, the next 12 to 18 months could be pretty flat in the property market, i.e. you will get your income, mostly anyway, unless you've got Wilco as a tenant, and you probably won't see much happen to capital values. I've been kind of saying to people for the last few months now that it feels as though the property market, the property sector, is living under the macro scope, which is about as funny as I get, I'm afraid. But it is kind of a truism that we are highly focused on where interest rates and inflation and so on are heading, and where we expect them to land. As long as they behave as expected, I believe that the commercial property market has, by and large, priced that in. I'm not saying that they've got it right to the decimal place, but we're not about to see, I don't think, a sort of another 20% step down in values, or indeed a 20% step up. Watch this space. Interest rates going back below 4 might sort of change my view on that. But I think if we see them flatline in the sort of 5 to 5 3/4 arena, then you won't see too much happening in the commercial property sector for now.
So thank you, Oli, and to Richard for those great insights, and to you all for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now wherever you're listening, or share it on your socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. So we'll be back next week, and in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, if you have any questions you'd like to ask one of our experts for our next podcast, then simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thanks again to Richard and Oli for your time, and to you all for listening. See you next time.